put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The story of the company you've never heard of. There's a company that owns more of Apple than Steve Jobs ever did, more of Microsoft than Bill Gates, more of Amazon than Jeff Bezos himself, a company that holds pieces of nearly every major corporation on Earth, controlling an empire worth over $11 trillion. Yet if you walked past their headquarters in Malvern, Pennsylvania, you'd barely notice the building. No gleaming towers, no chrome and glass monuments to wealth, just a quiet, unremarkable structure that houses the most powerful financial force you've never seen. This is the story of Vanguard, the silent giant that has woven itself into the fabric of global capitalism, so completely that its influence has become almost invisible. Almost. The question isn't whether Vanguard controls your financial future. The question is whether anyone is controlling Vanguard. In the shadowy world of wealth and power, there are billionaires you can see and billionaires you cannot. The ones you can see buy yachts, launch rockets, and tweet at 3 a.m. But the ones you cannot see, they own the companies that build the yachts. They own shares in the rocket companies. They own pieces of Twitter itself. Vanguard is the ultimate invisible empire in this business thriller, unfolding across global markets. It began in 1975 with a man named John Bogle, a financial visionary who saw something rotten in the money management industry. Mutual fund companies were bleeding their clients dry with fees, commissions, and charges that silently devoured returns year after year. Bogle had a radical idea. What if there was a company owned by no one except the people who invested in it? A company with no outside shareholders demanding profits, no Wall Street pressure to maximize fees, no hidden masters pulling strings from mahogany boardrooms. He called it Vanguard, after the flagship of British Admiral Nelson, and launched the world's first index fund available to ordinary investors. Wall Street laughed. They called it Bogle's Folly. The initial fund offering in 1976 raised just $11 million, a humiliating failure by industry standards. But Bogle wasn't building an empire for quick profits. He was building something far more dangerous, a machine that would slowly, quietly accumulate power by offering something deceptively simple: low costs, broad diversification, steady, patient growth. In the world of high-stakes finance, patience is the most underestimated weapon. While hedge fund managers made fortunes on billion-dollar bets and investment banks chased quarterly earnings, Vanguard simply bought everything and held it. They weren't trying to beat the market. They were becoming the market. By the 1990s, something strange was happening in corporate America. When executives looked at their shareholder registries, they began seeing the same name appearing over and over: Vanguard Group. Not as a raiding corporate marauder like Carly Khan, not as an activist investor like Bill Ackman, just there, quiet, patient, growing. The beauty of Vanguard's strategy was its invisibility in the business documentary of modern capitalism. Index funds don't announce their intentions. They don't issue press releases or make hostile takeover bids. They simply mirror the market, buying stakes in every company according to mathematical formulas. Automated, algorithmic, unstoppable. But here's where the real-life business story takes its first dark turn. As Vanguard grew, it didn't just become big. It became systemic. By 2010, Vanguard managed over $1 trillion. By 2015, $3 trillion. By 2020, $7 trillion. Today, it controls over $11 trillion in assets, making it one of the 3 largest asset managers on Earth, alongside BlackRock and State Street. Together, these three companies form what researchers call the Big Three. They are the largest shareholders in 90% of all publicly traded companies in America. Think about that. 90%. They own pieces of Coca-Cola and Pepsi, McDonald's and Burger King, Ford and General Motors, Delta and United Airlines. Companies that are supposed to be fierce competitors all share the same major shareholders, all voting the same shares, all whispering in the same boardroom ears. This is where the business thriller becomes a question of power itself. When you own everything, do you compete with anyone? Academic researchers began noticing something peculiar in the early 2010s. Industries with high institutional ownership by the Big Three showed reduced price competition. Airlines didn't drop fares as aggressively. Banks didn't compete as fiercely for deposits. The theory went like this. If you're a CEO and your largest shareholders own equal stakes in all your competitors, what incentive do you have to start a price war that would hurt everyone's stock price? Better to maintain comfortable margins. Better to keep prices stable. Better to avoid the kind of vicious competition that benefits consumers but terrifies shareholders. Vanguard would deny this, of course. They'd say they're passive investors who don't interfere with management. But passive doesn't mean powerless. When Vanguard votes its shares at annual meetings, when it sends stewardship teams to meet with executives, when it issues guidelines on executive compensation and corporate governance, it's exercising power that touches trillions of dollars of market value. Passive investing, it turns out, is only passive until it isn't. But here's the truly chilling part of this corporate scandal that isn't quite a scandal yet. Who owns Vanguard? The answer should comfort you. Vanguard is owned by its funds, which are owned by the investors in those funds. It's a mutual structure, unique among giant asset managers. No shadowy billionaire controls it. No private equity firm can buy it. It exists as a kind of financial cooperative, theoretically accountable to the millions of ordinary people who invest their retirement savings through its funds. But here's the paradox that keeps financial theorists awake at night. Those millions of ordinary investors, they're passive too. They don't vote on how Vanguard stewards its proxy votes. They don't decide which corporate governance positions Vanguard takes. They simply own shares in funds, and Vanguard's investment stewardship team, a group of perhaps a few hundred people, makes decisions that affect trillions of dollars. So you have a company owned by everyone that's controlled by almost no one. A leaderless army of capital that operates according to algorithms and committee decisions, spreading its influence across every corner of global capitalism without any single person or entity being able to direct its power. It's the perfect business crime that isn't a crime. Concentrated power without concentrated accountability. Consider what this means for wealth and power in America. The rise of index funds has been celebrated as democratizing finance, letting ordinary people access diversified portfolios at rock-bottom costs. And that's true. Millions of teachers, nurses, engineers, and retirees have built wealth through Vanguard funds. But at the same time, the voting power attached to all those shares flows upward to a tiny group of stewardship professionals who decide how to vote on executive pay, board elections, merger proposals, and environmental policies across the entire economy. Democracy in wealth creation, oligarchy in corporate governance. That's the hidden bargain at the heart of the index fund revolution. The entrepreneurship secrets here are subtle but profound. John Bogle built his empire not through aggression, but through patience. Not through complexity, but through radical simplicity. He understood something most billionaires don't. That in finance, the person who charges the lowest fees eventually owns everything. It's the inverse of the luxury goods business. In luxury, you charge the most, and serve the fewest. In index funds, you charge the least and serve the most, until you become so large that your market power exceeds any traditional monopoly. By 2000, Vanguard had become the largest mutual fund company in the world. Bogle had stepped down as chairman, but his philosophy remained embedded in the company's DNA. Keep costs low. Serve the investor. Avoid speculation. Stay boring. But boring, it turned out, was the most effective strategy for accumulating power in the history of modern capitalism. The 2008 financial crisis should have been Vanguard's moment of reckoning. Markets collapsed. Banks failed. Investment firms that had grown fat on leverage and complex derivatives faced extinction. But Vanguard simply held steady. Its index funds dropped with the market, of course, because they mirrored the market. But there was no Vanguard bailout, no emergency rescue, no congressional hearings about reckless risk-taking. The company's mutual structure meant it had no shareholders to panic, no stock price to collapse, no survival crisis. It just continued operating through the storm. And when the markets recovered, Vanguard emerged more powerful than ever. Investors who had been burned by active fund managers and complex strategies flooded into index funds. The company's assets under management exploded. By surviving the crisis without drama, Vanguard had proven the power of its model. But it had also become something John Bogle never intended. Too big to ignore. Now we arrive at the darkest chapter in this financial mystery. The chapter that's still being written. The chapter that asks whether the concentration of corporate ownership in the hands of a few giant asset managers represents a threat to capitalism itself. In 2018, a group of economists published a paper with a chilling title, Common Ownership, Competition, and Top Management Incentives. Their research suggested that when institutional investors like Vanguard own significant stakes in competing companies, those companies become less competitive. Executives face weaker incentives to gain market share from rivals, and consumers pay the price through higher prices and reduced innovation. The paper estimated that common ownership in the airline industry alone had cost consumers billions of dollars in higher fares. Other researchers pushed back, arguing the evidence was inconclusive. But the debate revealed something unsettling. No one truly understood the implications of having such vast ownership concentrated in so few hands. We were running an experiment on capitalism in real time, and the results wouldn't be known for years or decades. Consider the stock market secrets here. When Vanguard votes its shares, it doesn't vote as a monolithic block for its own interests, because Vanguard, in theory, has no interests except those of its fund investors. But its fund investors are holding diversified portfolios. They own the whole market. So what's good for Vanguard investors isn't what's good for Company A versus Company B. It's what's good for the entire market, which often means avoiding disruption, maintaining stability, and favoring incumbents over insurgents. This creates a subtle but profound bias in favor of the status quo, not through conspiracy or malice, but through the mathematical logic of diversified ownership. If you own all the pharmaceutical companies, you don't want any single one to launch a price war. If you own all the tech giants, you don't want them engaging in destructive competition. You want stability, modest growth, and controlled innovation. You want the garden, not the jungle. But capitalism is supposed to be a jungle. Creative destruction, Joseph Schumpeter called it. The constant churning where new companies rise and old companies fall, where competition drives innovation, where the threat of failure forces excellence. What happens when the largest shareholders in the economy have a structural incentive to reduce that creative destruction? John Bogle himself began expressing concerns before his death in 2019. The man who created the index fund revolution worried that his creation had grown too powerful. He argued that index funds should not be allowed to vote their shares, or should vote only according to the explicit instructions of individual investors. He feared that Vanguard and its peers had accumulated a degree of corporate influence that could threaten the free market system he had devoted his life to democratizing. The billionaire secrets and money and greed of traditional finance are easy to spot. Lavish offices, private jets, $100 million bonuses. But Vanguard's power is different. It accumulates through compound interest, through fee advantages measured in basis points, through the slow mathematics of market-matching returns across decades. There's no dramatic moment of conquest, no hostile takeover, no newspaper headline announcing the completion of a master plan. Just inexorable growth year after year, until suddenly you look up and realize that a single company has become the largest shareholder in most of the economy. Today, Vanguard stands at a crossroads between competing visions of its future. On one hand, it remains true to Bogle's founding principles: low costs, broad diversification, investor ownership. It has resisted the temptation to launch complex products or chase higher fees. Its corporate culture remains notably unglamorous for a company managing more wealth than the GDP of Japan. On the other hand, its sheer size has made it a political target. Progressives criticize it for not using its proxy votes aggressively enough to combat climate change or push for social justice. Conservatives accuse it of caving to ESG pressure and putting politics ahead of returns. Economists debate whether it represents a new form of monopoly power. And regulators circle, wondering if they should treat asset managers as systemically important financial institutions, requiring special oversight. The rise and fall pattern of business scandal documentaries doesn't quite fit Vanguard because there has been no fall, no fraud exposed, no crimes charged, no executive perp walks. Instead, we have something more ambiguous and perhaps more troubling: a company that became too successful at its own mission. Vanguard set out to democratize investing and largely succeeded. It helped millions of ordinary people build wealth through low-cost index funds. It forced the entire industry to lower fees, saving investors hundreds of billions of dollars. It proved that patient, disciplined, low-cost investing beats speculation and market timing. By every measure of its founding mission, it won. But in winning, it created a new problem. What happens when the democratization of ownership leads to the concentration of control? When millions of individual investors collectively own trillions of dollars, but a small group of proxy voting committees decides how all those trillions vote? When the company meant to serve, the little guy becomes so large that it's setting the agenda for boardrooms across the entire economy. These aren't questions with easy answers. They're the questions that define the next chapter of capitalism itself. And Vanguard sits at the center of them all, a quiet giant in a small Pennsylvania office building, holding more economic power than most nations, accountable to everyone and no one at the same time. The business crime here, if there is one, is not in what Vanguard does, but in what the system allows to happen when passive investing becomes dominant. It's a crime of unintended consequences, a crime of emergent complexity, a crime where everyone follows the rules, yet something fundamental about market competition gets quietly eroded. As you watch your retirement account grow through some Vanguard index fund, as you sleep soundly knowing your fees are rock bottom and your diversification is broad, there's a question worth considering. In building a machine to serve millions of investors, have we accidentally built a machine too powerful for any democratic system to control? The lessons from this dark business story are paradoxical. Sometimes the most dangerous power is the power that seems most benevolent. Sometimes the greatest monopoly is the one that lowers prices instead of raising them. Sometimes the most significant corporate scandal is the one where nobody breaks any laws. Vanguard exists in a legal and ethical gray zone that regulators are only beginning to understand. It's not a bank, so it's not regulated like a bank. It's not an insurance company. It's not even technically an investment advisor to most of its clients. It's a fund company that happens to have become the largest owner of corporate America, almost by accident, through the compound mathematics of low fees and passive investing. And that might be the most unsettling part of this entire story. There's no villain here, no greedy CEO looting the company, no fraud scheme, no insider trading ring, just a series of rational choices, each defensible on its own, that collectively created a concentration of corporate control unprecedented in the history of capitalism. John Bogle created Vanguard to fight the concentrated power of Wall Street. He succeeded beyond his wildest dreams, but in the process, he may have created a different kind of concentrated power, one that operates through passive algorithms rather than active greed, but one that is, in its own way, just as unaccountable and just as potentially dangerous. The next chapter of this story is still being written. Will regulators step in to limit the voting power of index funds? Will a new generation of investors demand more control over how their shares are voted? Will the concentration of ownership continue until a handful of asset managers effectively control corporate governance for the entire economy? Or will some new innovation disrupt the disruptors, creating a new model that solves the problems Vanguard accidentally created? What we know is this. Right now, today, $11 trillion flows through the quiet offices of Vanguard Group. $11 trillion that holds pieces of your retirement account, your bank, your employer, the company that makes your phone, the airline you fly, the drug company that produces your medicine, and thousands of other companies woven into the fabric of daily life. $11 trillion. Voting on boardroom decisions, executive compensation, climate policies, and merger approvals. $11 trillion controlled, in practice, by a few hundred investment stewardship professionals working for a company you've probably never heard of. That's not a conspiracy. It's just the logical conclusion of building a better mousetrap in the asset management business. Lower your fees enough, stay boring enough, be patient enough, and eventually you own everything. The silent giant controlling global markets doesn't need to announce its power. It doesn't need a charismatic leader or a sinister master plan. It just needs to keep doing what it's been doing, being cheap, being diversified, and being passive. The rest takes care of itself. And that might be the darkest truth of all. In the modern financial world, the path to absolute power isn't paved with aggression or greed. It's paved with low expense ratios and index funds. The most dangerous empire is the one that everyone builds together, one retirement contribution at a time, never realizing what they're creating until it's too late to turn back. Welcome to the silent empire. You're already a part of it. Subscribe and listen to our next story below.